How's it going, everyone? This is Theta Warrior. Today we're going to be discussing put writing. What is it? How to identify it? Is it bullish? Is it bearish? Etc. Always get a lot of questions about this, and it's really interesting stuff. And it's not that hard to identify if you know what you're looking for. And we got a great example of some really nice, clean put writing in Apple today. And this was going to be the trade that we're going to discuss. And we'll get right into that in a second. But first, I want to give you a definition. So it's really easy. The definition of put writing is just simply selling to open a put and collecting the premium. Yes, it is bullish. And I'll explain a little bit more why that is the case later. So selling to open, that's the key. And if you're unfamiliar with BlackBox, it's a great software. They color coordinate everything. And these little letters on the end, B stands for bid side, B below bid, A ask side, etc. So yellow is going to signify that open interest was exceeded in one single trade. So each one of these lines of trade, because all of these are different trades, exceeded the open interest. And in case we wanted to double check, we can go to our broker, the open interest options chain, and look. I've already pulled it up here on Yahoo Finance. We have the puts for June 10th. The open interest coming into today was 114 contracts. So these were easily exceeding the open interest. You can see this is the contract count on the left. This first one came in at 549, then 1629, so on and so forth. So got a little handy checklist for us here. This is what we want to look for when we're identifying put writing. Is the trade bid side? So what is bid side? So as you know, there's a spread, right? For any option contract, you have a bid and you have an ask. So let's say you market order something. You're trying to sell, regardless if it's call or a put. If you market order, they're going to fill you on the bid because that's, how they make money. That's how it's been done forever. So selling bid side. Yes, we have it right here. And keep in mind, these were the first trades that came in 127. Okay. On the East Coast. Final trade came in 52 seconds later. All of these happened in less than a minute. The very first one came in on the bid. The next trade a second later came in below the bid, and you can see that the contract price dropped. That's why it came in below the bid. And then a lot of people get hung up on, okay, well, why is this on the ask? Because Theta, I know that buying happens on the ask. And a lot of the time you're right. If you market order a call or a put, you're trying to get in, they're going to fill you on the ask 9 times out of 10. And why is this situation different? Well, it's important to pay attention to the timestamps. Okay. But first, before we get into that checklist, yes. Okay. Trade is bid side to start. We got our first 2 main lines, about $1.4 million on the bid. Okay. Is the trade opening? Now we kind of just went into that. This is all yellow. So we know that it's above the open interest. The open interest coming in today was only 114 contracts. That means that it has to be new opening. Okay. The only way that this could be closing is if the contract count was 114. So we know that it's obviously way above that. This last line came in at 8,400 contracts. So this is definitely a new trade. Okay. Definitely brand new contracts being opened. So that's another yes. Now, does the IV go down? Okay, on here on the right, we have the implied volatility of this trade. In 52 seconds, the implied volatility dropped from 35 to 34. That's a yes. So why will that happen? Now, as implied volatility goes higher, contracts get more expensive. Doesn't matter if it's calls or puts. So that's kind of like a market maker's way of hedging against you buying, a ton of contracts as prices ripping and they're trying to hedge. They'll raise the implied volatility as you're buying those contracts as kind of a way, to cushion themselves, as a way of protection, because then they just drop the implied volatility and then your contracts go down in value. Now, the opposite will happen when you're selling to open contracts. They'll drop the implied volatility ahead of time, or I'm sorry, as you're opening, as you're getting into the position to try and give you the lowest price possible. Because this market maker, the first one came off at 685, and at the end they're paying 680. The lower this market maker can pay you for these contracts, the more money they potentially can make, right? So they don't want to pay you any more than they have to. So they'll drop the implied volatility as these trades are coming in. This is a key thing to look at. Implied volatility comes down as time goes on, right? And keep in mind, the closer sequential, trades that you have come in, the more important this is going to be. IV can change a lot in 10 minutes. This is 52 seconds. The implied volatility came down. So clearly, this is going to be all selling to open. Remember, that's the key for put writing. It has to be selling to open. So we know that it's bid side, it's selling. We know that the trade is opening because the flow is denoted as yellow. So we know that it's a brand new opening trade. The implied volatility comes down, okay, 35 to 34. And then the last main thing we look at is, does the contract price drop along with spot? So spot would be the price of Apple. Okay, so this is spot. The first trade came in with Apple trading at 159.97. Next one, 95, 96. A couple seconds go by, they drop it to 83 and 82. So spot, or the price of Apple, is lowering, right? Now, what normally happens as spot drops? A put would increase in value, right? Because they're inversely correlated. As price comes down for the underlying, the put becomes more and more expensive. It gets higher and higher and higher. So we have spot dropping, but you'll see the first trade came in at 685, then they immediately dropped it to 682, and then the rest of these get filled at 680. So why did that happen? The spot dropped, so this put should be getting more expensive. We're not looking at it from the market maker's perspective. They're going to try and give you the least amount of money possible when you're selling to open, right? So if this was buying, especially big size like this, these contracts would be getting higher and higher and higher, especially with spot coming down. So this next one may be 690, this might be 705, so on and so forth as spot continues to go down. But we don't have that. So this is the nail in the coffin. This is the smoking gun right here, that this is 100% every single line put writing, every single one. It's all done by the same trader, the same desk. I'll tell you how I kind of have an idea of that. Of course, I can't say with 100% certainty. It's not me who did this, so I don't have 100% certainty. But I can say more than likely this is one trader, one person, one desk, hedge fund that's doing all of this together. So the icing on the cake, we got the spot dropping as contract price comes down. They both move in relation to one another, which usually does not happen. Okay, and then the real icing on the cake, and this is a brand new feature that's coming out from BlackBox in the next couple of days, week, should be really soon, is does the put option net delta increase? Now, I'm going to make another video on exactly what this is and how to look for it later on. But this right here is a new study coming out from BlackBox. This is the flow we were just looking at on the software. And essentially, net option delta is just a calculation of all of the delta that is being sold and bought throughout the day. So in this indicator, we have the call delta in the blue, which we won't look at that today because we're looking at puts. The pink delta, the put delta in the pink, and then your total in the white. Okay, so puts have negative delta. So as you're buying puts, the delta is going to decrease. It's going to become more and more negative, right? And the opposite with calls. Call delta is always going to be positive. So as you're buying calls, the net delta is going to increase, increase, increase. So it doesn't matter if puts are sold to open or sold to close. When a put is sold, that delta, which keep in mind is inherently negative, is going to become more positive because there's less negative delta out there, right? So this is our pink line right here. You can see these came in at 127. So there's, this is military time. That's right there, 127, 1327 military time. We see a big spike in the put delta, right? That's because they're selling these. If you needed any more confirmation, it's right there. That spike in the put delta confirms that this is all selling. Now, these two first at the bid and below the bid, 1.4 million, yeah, that would cause a spike in the put delta. But if this was all buying, that's what, 7-8 million in change, this would decrease. This pink line would come way back down to where it even started. It'd be down here somewhere, if all of this was buying, because this is obviously the bulk of the trade, but it didn't, came all the way up. It launched it higher. So we know without a doubt, this is all selling. Okay. So right there, we've got the main four, and then this great new indicator that everyone will have access to soon. All five of these things. Yes, 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 yes. On our put writing checklist, 100% put writing bullish. Okay. This trade is 100% put writing, as confirmed by, our checklist. And feel free to screenshot that. If you want a copy of it, just comment on the tweet and I'll send it to you or something. Happy to do that. So let's get into why Theta did these three go off on the ass, because I'm confused, and that to me looks like buying. Well, I'll tell you what happened, and it really helps to visualize it because I'm a visual person. So I've made up a little spread example. Now, I know things don't trade on the quarter anymore, but this is just a simplified example of an options chain, the bid ask, right? So you've got your price starts at 550, goes up to 750. Let me just take a quick little screenshot here so I can mark on this. And then we'll pull up the flow at the same time. Okay, so this is our spread example. And we can see the contract price. The very first one went off at 685. Okay, so we'll take our little pen tool. We'll mark just like so. There's our bid. And there's our ask. Okay, this is a mock spread. So the very first trade went off on the bid, right? Which is what you'd expect with selling, market order sell, going off on the bid. Then what happens as spot is dropping, the spread moves. So now all of a sudden, sorry, I'm going to draw that again. I don't like that. Now all of a sudden, that's our new spread. Bids here, ask is here. Okay, so the spread moved down, but price of the contract did not. So the majority of the contracts were filled right here in the sweet spot between 675 and 680, 690 or so, right in between there. So the very first two trades filled on the bid, and then boom, they moved the spread over. All of a sudden you're filled on the ask, but spot of the contract price stays the same. Okay, that's why you get that on the ask, but it's all selling. It's all part of the same trader. And getting into why I think this is all the flow for Apple. You can look and see my filters. I'm looking at everything besides multi-leg, but I don't have anything else checked. So we're looking at it all: bid side, ask side, opening, closing, everything. Okay, scrolling down, obviously it's a ton of flow. And you'll see when we come up to it in a second, because it stands out, because it's yellow. White is going to mean open interest not exceeded. Purple means open interest has been exceeded through multiple trades. Yellow means open interest exceeded in one single trade. Okay, and you can see it all. This is it right here. So 126, 127, boom, there's our first line, bid. Next one below the bid, a second later. Okay, this may actually be related, but we're just going to stick to the 610 160s here. And you can see they all come in around the same time, not much happening in between. Obviously, there's a whole market out there, so there's going to be a few other trades mixed in here. But you can see for the most part, this happened pretty quickly. So looking at this the rest of the day, there's none other lines of that flow that traded. So that's why you'll see some of my tweets, they say single trader, or desk, meaning like, a hedge fund desk, is because this happened in 52 seconds. The coincidence of that being one, or multiple people is, would be crazy. Maybe if it was a few minutes difference or something like that, then maybe so, but 52 seconds, seriously doubt that's going to be, two different people without the same intention. So quickly wrapping this up here, we had a total, I did the math for you, 14,879 contracts were traded in this flow right here. That's the total of all of these. And we can see that our volume for the day was just over 15,000, almost 15,500. Now, if we really want to be sure that this is all opening, then tomorrow we need to check and see what this open interest is. Now, keep in mind, you have to give it a little bit of leeway, but there should be roughly 14,000 to 14,500 contracts open right here. Now, you can see obviously the volume was higher. There was probably a couple tag-alongs. Maybe they closed some of it, a couple hundred contracts or 100 or so. Who knows? But it's very close to the total volume of the day on this single series here. So checking the open interest tomorrow. If the open interest is 100, then we know I'm wrong. Then we know that it was buying and selling. They flipped it out. Who knows what happened. But if that open interest is 14,000 and change, then we know for sure that this was 100% opening writing of puts, bullish intent. And quickly, just to educate you on, what this actually looks like. Again, I'm a visual learner. So this is the graph of a put write. Now, we don't know if this is uncovered or not, so just ignore that part. But in this example, this trader sold the 45 put and they collected $200. Okay. This trade will make money above what the strike is, and the difference of what the strike is and what they collected for it. So this right here, where this line, you see it goes to 0, that's right there is 43. Okay, so we know that this trader now technically owns the stock at 43. So 45 strike minus $200, they have a 43 break-even price. Anything below 43, they lose money exponentially, in theory, if it's not a cash covered put. So, but they'll make money anything above 43. So if it's 44, they make $100. If it's 45, they make $200. If it's 50, they make $200. If it's 60 or 100 or 1,000, they always will make $200. You can only make what you collect in the beginning. So this is the graph of how put writing works. So keep in mind, uncovered, you have technically, risk down to 0. So these guys, they sold these at 685. Okay, quickly we'll pull up the calculator here. 160 minus 685. So technically these guys own the stock at 153. So maybe they're okay with owning it at 153. Maybe they're hoping that it stays above 160 and they get to collect and keep the entire premium amount sold. Keep in mind though, this trade is profitable anywhere above 153.15, roughly average these in. They'll make money if the stock is 155, 157, 158 at expiration, which again is 610. So a lot of ways to make money when you're writing puts. It's you don't have to necessarily get the direction correct. This could trade down to 155 and then close up at 165, by the expiration, and they'll make all this money. They're collecting all of this, right? So their brokerage account just gained, $8-9 million or so. Not to mention the size of the account. Obviously, you need to write something like this, but that's how it works. So I hope this was helpful. I hope this put the mystery to rest. Is put writing bullish? Yes, it is. And how to look for it? This is your checklist. This is your sweet spot. Great example here of the flow. Any questions? Feel free to comment on one of my Twitter posts or on this YouTube video. Always happy to help. If you're interested in BlackBox, I'm an affiliate. I'm a partner. You can use my referral code and get 20% off. Software pays for itself. I guarantee it. I use it every day. I love it. And it's great. You can find, cool, interesting things like that. So again, hope that was helpful. I'm going to sign off here and hope you guys enjoyed the video. Thanks again.